morning everyone, welcome to sadywelljapan.com. Today's lecture is about director's salary. It's very important, so please listen carefully. The principal law under Japanese tax law is director's salary is not deductible, so it can't be treated as expense, basically. But why is it? I think many people think the same things. Because the directors can decide their own salary by themselves. So what does that mean? The directors' salary can be used as a tax evasion. So I will explain you how the director's salary is used for the tax evasion. So to understand that, I need to explain you about the basic rule of the Japanese tax systems. When you running the business, when you have the company, basically you have to pay the two types of the tax. The first one is corporate income tax, and the second one is you have to pay the personal income tax for your salary. And corporate tax rate is the tax rate for the corporate tax is fixed rate. It's 23.4% right now, and on the other hand, the tax rate for your personal income is progressive tax rate. So when your income is going up, the tax rate is going up too. So the maximum tax rate is 45%. So this picture shows you how the director's salary can be used for the tax evasion, because the directors can decide their own salary by themselves. If the directors decreases their own salary, the company's profit is going up, and if the directors is increasing their own salary, the individual personal income tax is going up. So when you, for example, when your company make a lot of the revenues, directors can increase their directors' salaries and decrease the net profit of the companies. And if your personal income tax rate is lower than corporate income tax, because that happens because your personal income tax is progressive tax rate, you can save tax, and you can save like most effective the income allocation. But there is a way to treat director's salary as an expense. Basically, director's salary has to be monthly equal amount, so you can't just fluctuate your director's salaries. And basically, once you decide director's salary, you can't change it. But there's exception. You can change the director's salary within 3 months from your company's beginning of the fiscal years. You can change just one time by holding shareholders meetings. How about the bonus? Director's bonus is, of course, it's not a deductible item, but there is a way to treat it as a deductible expense. What you have to do is you have to report the amount of director's bonus to the tax office in advance. You have to file the application, and you need to pay the exactly same amount as you reported to the tax office in advance. But basically, I have not seen many cases, many companies which is using this system, because it's kind of difficult to know the company's revenues in advance and decide the amount of the bonus. It's a bonus, so it should be depending on the result of the company's net profit. So not so many people is using this rule. So to save your tax, as I explained to you, once you decide direct salary, you can't change it. So you have to estimate the annual income from your business in advance and decide and find out the most tax effective amount of the direct salary in advance. So it's kind of difficult, I think, but it's worth doing it. So I recommend you to talk with your tax accountant before you start business. And this is it for today's lecture. Thank you for listening. See you. Thank you for watching sadywellj.com. My name is Sada. I'm a Japanese tax accountant and helping entrepreneurs in Japan. If you want to know more detail, call me now. See you next time.